Which brings us to our Muni moment. U.S. voters approving about $52 billion of state and local government borrowing measures, ranging from education improvements to a transportation referendum. So joining us now is Bloomberg's Muni reporter, Nic Querolo. Nic, I know that California kind of stole the headlines with a pair of $10 billion statewide propositions, but give us a sense of what voters approved of.
Sure. So California was really kind of the story here. There were two massive bond referendums that both passed. Not by a huge margin, but I think it was surprising because California is a high-tax state. The cost of living and inflation were really present issues in the election this year. It was surprising to us that they were able to get these two really big bond measures passed, and it showed you how much California voters really are concerned about A, climate change, and B, the state of their schools.
But this was also a story nationwide, and we saw this in other states here, some of these referendums, and the idea that infrastructure and its importance to, I guess, the growth of the local economy. Talk a little bit about that.
Absolutely. So we really pay attention to these bond referendums closely in the muni market. It gives you kind of a sense of how the supply is going to look next year. About $50 billion of $80 billion was passed. So that was really surprising to us. It was a pretty healthy degree of voters approving these types of measures, which tend to increase people's taxes. Mm-hmm. And also what was interesting to us was there were some pretty big rejections too. So Houston, for example, one of the biggest school districts in the country, was asking for $4 billion. That was handily rejected by voters. And it really just shows how kind of case by case and hyper local some of these decisions are based on kind of the needs of the community and what the economy feels like.
So put it all together, what does supply look like for the next couple of years? Because these are long-term spending measures.
Correct. So we saw a lot of issuers really expedite their borrowing plans to bring their bonds to market ahead of the election. October was one of the heaviest flow months for munis in years, and I think because state and local governments hate volatility, and they knew that this election would really throw fixed income markets probably into whack, and it has. We've seen a really big swing in this week, and investors are starting to kind of pair some of those losses we've seen, but this is going to bring a little bit of supply to the market that will kind of compensate for what was rushed to get out the door before the vote.
It raises a question, though, too. I mean, how much have interest rates factored into this? We've talked with a lot of folks heading into this election cycle about the drop in interest rates or the anticipation of a drop in interest rates and how that would affect issuance heading into 2025.
It's one of the interesting parts of the muni market. So unlike the corporate bond market, muni issuers tend to not be very interest rate sensitive. These are plans to build a new bridge or to repave a town's roads that usually are started at a council meeting, and they take years to plan. They don't have the kind of flexibility that a company might have to bring projects to market when the interest rates are comfortable for them. So I don't anticipate seeing very much change due to the kind of interest rate fluctuations. More so, a lot of this stimulus money that you were talking about is starting to roll off the books of these governments. They're going to start to need to find some new sources of capital to, fix the infrastructure that always needs upgrading.
All right, and of course, I'm sure you'll be all over that. Municipal bonds reporter Nic Querolo here, a closer look here at maybe a potential shift here in the landscape of municipal finance.